Good evening, people. Welcome to the session. So today we would be learning about the next set of the concept, which will be towards the cost of capital. I believe we had a discussion about investment appraisal, and then I think somewhere we were in cost of capital, if I'm not wrong, as that's what I believe that we were in. So let's get into the cost of capital for our understanding better, people. First, an understanding about how does the cost of capital that works out for you guys. Like when I say for you guys, that understanding from a point of like how the whole cost of capital would be coming into the point. So I would be taking one or two questions on this to go forward, like move forward on this. Okay. um let's go accordingly. Let me just get a question for you guys. Okay, got it. So we would be solving one of the two questions. Let's do two questions on the weighted average cost of capital as overall. Okay, people. So let me pick the question called Tufa Company, or is it that we have already calculated? I believe we have already calculated. So I'll pick up something a little more difficult under the point. So I would pick up a question from capital asset pricing model. Like let's go to card company. Okay. Okay. I'll try to do one more question on the same thing. Okay, guys? I believe you guys can see the question. So let me also bring up the requirement for you. Yeah. Okay. So we have around five requirements. I know five requirements is not something that is easy, right? So, but it's okay, guys. It is good that we can take five different requirements on the part. Okay. The first, if you see, they're asking you to calculate the cost of equity of card company using the dividend growth model. Why this is coming up? Yeah, I believe every For everyone it is visible. So the first requirement that they're asking you to do is calculate the cost of equity of card company using the dividend growth model. So I'm keeping it on the right hand side because I believe somewhere strongly I believe that this side of the screen can be used on the requirement, because I would be able to solve few things here. So read the information available for card company. See, card company has an issue 8 million shares with an ex dividend market value of $7.16 per share. A dividend of $0.62 per share of for 2000X6 has just been paid out. Okay, so we know for 2000X6 how much is the dividend that we have paid, D0, that is 0.62. The pattern of recent dividend is as follows. We have got the recent dividend. So if you have to even calculate the cost of equity, people, what is the formula for cost of equity? If you remember, the cost of equity would be KE, that is cost of equity, is equals to, you know, D1. Let me write that. So the cost of equity formula would be D1. D1 would be the dividend after 1 year upon P0 whole plus the growth rate. So first for that you should find out the growth rate. So how do you find out the growth rate? We would use the geometric method. So how does the geometric method works? We will take dividend now D0 upon dividend n years ago raised to the power. What do you consider raised to the power? Number of years. You have to see 1 divided by number of years is what I will have to take. So what is 1 divided by number of years? If you see, so from 2000X3 to X4 1 year, X4 to X5 2 years, X5 to X years 3 years. So I would be taking this upon raised to the power 1 by n whole minus 1. This is the formula that you can expect. Okay, so finding out with the same calculation, how am I going to do? Look at this. What is my D0? D0 is 0.62, people. 0.62. Sorry about it. Divided by what is my DN? N years ago, it will be of 0.551. 0.551, isn't it? Correct, yeah. So 0.551 raised to the power. How do you raise it? Raised to the power. Open one more small bracket. 1 divided by 3. You have to do this. Don't directly put raised to the power 1 by 3. Like that will not give you the marks. Then this divide minus 1 would be the answer. So first go ahead and calculate how much is 0.62 upon 0.551. Yep. 0.62 upon 0.551, right? Yeah, 0.551. Close this. Again, raise to the power. Open the bracket 1 divided by 3. Then close the bracket minus 1. See, what is my growth rate, people? If I have to convert this to my percentage, my growth rate comes in this way. It would be 4.01 percentage. I can take it as how much? I can consider that as 4.0. I can just consider that as 4 percentage. Just take it as 4 percentage. Okay. Now after 4 percentage, what happens right now? We have to calculate. Now I know growth rate. I know D1 dividend. D is how much? D would be D0. So if you have to calculate D1, it will be D0 multiplied with 1 plus growth rate. Correct, people? Yeah. So how much would be D1? D1 is nothing but D0 is 0.62. D0 is $0.62 multiplied with 1 plus 4 percentage. Correct? Yeah. So if I have to find this out, how much would be my D1? It will be of 0.62 multiplied with 1.04. That will be 0.65 would be my D1. 1. So I got to know what is my D1, and I know what is 64 is my D1. Okay. So what is my D1? D1 is 0.64. If I have to find out my cost of equity will be nothing but 0.64 divided by, what is my ex dividend price? If you can say ex dividend price is 7.16 whole plus the growth rate of 4%. This would be the formula. If I go ahead and do that, how much would be my cost of equity in terms of the right answer? It will be, take the symbol, be 0.64 divided by 7.16 plus 4%. So you guys should be getting somewhere around. So if I just round it off, I should be getting 13%. So you can consider that as 13% is my cost of equity. So this would be requirement number A, cost of equity using dividend growth model. Yeah, let's see what is the next requirement, people. Now read the information before you move to the next requirement. Card company also has an issue of how much 8.5% loan notes redeemable in 5 years time for the total nominal value of how much? Total nominal value of 5 million. The value of each $100 loan note is 103.42. Redemption will be at nominal value. So if I have to calculate redeemable loan notes cost, guys, cost of debt, you should know there is something called IRR that I have to calculate, right? Yeah. So if you can calculate that IRR, we will be able to find out the percentage for it, if I'm not wrong. Okay. Okay, great. So now move to the next information. We just want information because the next requirement is not calculation. It's about the discussion. Now card company is planning to invest a significant amount of money into a joint venture in a new business area. It has identified a proxy company with a similar business risk to the joint venture. So the proxy company has an equity beta of 1.038 and is financed 75% by equity and 25% on a debt market value. So we have to calculate project specific cost of equity for card company. If you see option D, that's where this information comes close to. We have current risk free return of 4% and average equity risk premium is 5%. Card company pays profit tax at a rate of 30% per year and has an equity beta of 1.6. Okay, let's read the next information requirement. The next requirement is discuss whether the dividend growth model or the capital asset pricing model should be used to calculate the cost of equity. So you guys need to understand, they're asking you to discuss. So when would you use DGM? When would you use CAPM is what the question here. First, understand. See, the dividend growth model calculates the apparent cost of equity in the capital market provided the current market price of the share. So it takes the current dividend and the future growth rate is known. Like we know what is the future growth rate that you can expect. So imagine when the information for the current market price and the current dividend are readily available, you need to understand it is very difficult to find an accurate value for the future dividend growth rate. Correct, people? Yeah. So why? Because it can be changed, right? A common approach to finding the future dividend growth rate is to calculate the average historic dividend growth rate, then to assume that the future dividend growth rate will be similar. So what do? We will not go ahead and say, okay, today the growth rate, like from yesterday to today, there is a difference. So let me go ahead and do it. You can't be like that. Okay. Rather, what would I do? I would go ahead and consider the differences. So are we clear about it, people? Yeah. Right. So now understand. So a common approach to finding the future dividend growth rate would be of how much future dividend growth rate would be, considering the point, um, it will, you will see that from last 5 6 years how much would be the dividend growth rate, and you would be considering that would be your assumption, and that gives you the future dividend growth rate. Like even like for overall it has been 7% increase, I would expect this year also 7% increase. It doesn't consider other stuff which is there in the organization, people. Okay, so I hope you guys got that. Right. So let's understand how does the capital asset pricing model works. See, capital asset pricing model works in such a way that you see, so the it prefers to the dividend growth model as a way of calculating the cost of equity, as it has sound theoretical basis. So the relating cost of equity or return required of well diversified shareholders to the systematic risk they face through owning the shares of a company. You need to understand capital asset pricing model is not so easy to calculate, because the information or the required information that we are looking out is quite difficult to get. Okay, so the dividend growth model, the dividend growth model calculates the apparent cost of equity in the capital market, provided that the current market, the relating cost of equity or the return required of well diversified. See, here what happens, people, everybody has this point. Now how can I say that there will be a well diversified risk always? See, you can't expect a person to just go ahead and invest everywhere properly, right? There is always a chance where this person might not be invested properly. That is always there. So you can't expect whatever they have gone ahead and consider would be the similar idea or similar point for everyone. But however, the variables that you use for the capital model would be risk-free rate of return, equity beta, equity risk premium. These can be found very, very difficult, right? So this, see, ma'am, how do I write an answer for this? I'm giving you a module answer from your ACCA study hub. So you guys can really go through this. And of course, you can put a pause for this video and go through, and someone who is there, you can just go through. I'll be giving a pause of 2 minutes for this, and you can do this as a answer points as well. You really no need to write everything what you can see there. You can go ahead and write whatever is as the additional point. Okay, right. So let me give a pause for a minute where I want you guys to go ahead and read it. Great. right? So let's move to the next set of your requirement. What is the next requirement that you can see in the question? So the next question that they're asking about is, they're asking you to calculate the weighted average after tax cost of capital of card company using a cost of equity of 12%. They're not asking you to use here as 13%. Instead, they're asking you to calculate with just 12%, which we have to go ahead and calculate, and it is after tax cost of debt. So first, what we have to do, people, we have to go ahead and calculate, IRR, which is cost of debt. That is how we will be able to calculate the remaining part. Let's go do requirement number C. After tax, weighted average cost of capital. So first we need to find out what is our cost of debt. How do you find out the cost of debt? We have to calculate IRR for that. How do we calculate IRR? People start with the calculation. So they have clearly said you would be paying how much? 8.5% is the interest that you can expect. Yeah. Redeemable in 5 years with a nominal value of $100. Loan notice redemption will be at nominal value. That means I would be getting 103.42, 100 at the 5th year. Correct? Yeah. So that means from T1, T0, what is that I can expect, people? I can expect an outflow of 103.42 in today's value. Correct? Let me keep everything, later will do. So in T1, what is the interest that you can expect? See, you can expect to have 100 multiplied with 8.5 percentage. This multiplied with 1 minus tax rate. Why tax rate? You see, the company's tax rate is how much? Did they give you the tax rate? Have they given a tax rate? Mm-mm. So if they have not given you the tax rate, I would suggest you guys to assume the tax rate, or let's see, just a second. Okay, I believe now you guys can hear my voice. I'm sorry, there's a power cut. You can't see me, but yes, you can still hear me, right? All you have to do is right now concentrate on the screen that is there. Okay. So yeah, we'll assume the tax rate as I'm assuming, or add information to the question. Tax rate being 30%. So now T2 also will be the same. T3 will also be the same. Correct? T2 will also be the same. T3 will also be same. T4 will also be same. T5, it will be whatever this value. Additionally, I will also get how much? I will also get 100. Right? So it will be 5 overall. 100, I would be getting 105.95. So now I'm just going to, for my understanding, because for the calculation purpose, I would put 0, 1, 2, 3, 4, 5. It makes myself little easy. So let me find out the discounting factor at 8% first, people. So it will be 1 divided by 1 plus 8% raised to the power this 0, and all you have to do is now drag it down so that you'll be able to get the discounting factors. Okay, and I would point के बाद 3 decimals. Okay, so then I would find out the discounted cash flows. Again, I should also find a discounting factor at the rate, let's say I'll keep this time 5%. So you have to take this copy paste, uh, but here it is going to be 5, and here I will give a reference to this one, right? So it goes this way. Yeah, cool. So what is the discounted cash flows? This multiplied with this value, and here the discounted cash flows would be this multiplied with this value. It down, and again drag it down. So you really no need to sit and calculate everything. You all you have to do is find out the sum, because this is what is very important for us to calculate the um, NPV. Oh my god. Yeah. Yeah, you see, this is how we have to calculate IRR. Now, what is IRR formula, people? IRR formula would be, I will take, you know, I will take lower rate LR plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. This multiplied with higher rate minus lower rate. So how do we do this? See, I'm just going to take it. First, open the bracket. What is my lower rate? Lower rate is 5 percentage. Lower rate would be how much? 5 percentage. And open the bracket. What you have to do, NPV at lower rate divided by, again open the bracket, NPV at lower rate minus NPV at higher rate. Close two brackets. Again, you add, yeah. Again multiply with one more bracket, that would be considered as how much? Considered as higher rate values, people. See, the market values of capital is what I have to find out. Let's start with equity. So equity, I know the share price is how much, people? The share price at the initial that we have seen is dollar 7 point, how much is it? If I can just go back, it's 7.16. Great. 7.16 into how many shares do I have in the company? Read the information. Can I see that I have 8 million shares? So all I have to do is take this value multiplied with 8 million. I'm writing all in thousands. So how much it would be? It would be 8,000 multiplied with 7.16. 57 million to $80,000 would be for equity. And if I move to debt, that is redeemable loan notes, that'll be of how much? That'll be of redeemable loan notes. And luckily I got my power back. Thank you, people. Yeah. So redeemable loan notes would be how much? Redeemable loan notes would be considered of, I have 5 million loan notes, but each loan note has a value of how much? Each loan note has a value of $100, and every loan note has a share price of 103.42. How much would be 103.42? 103 point, was that 103.42? By any chance? Just look at it. Yes, 103.42. So if I have to go, oh my God, control 103.42. So if I have to go ahead and calculate, what would be the value? It will be of 5 million divided by 100. Why? Because I'll get to know the total value of loan notes multiplied with 103.42. So this will be the value. What is the total market value, people? The total market value would be this much. Now, what is the percentage? Now, calculate what is the percentage of capital weight. Let's say weight. So I believe equity is playing a role of how much? Equity is playing a role of somewhere around 91.272 percentage, and cost is playing a role of how much? Somewhere around just point close to 8.28 percentage, if I'm not wrong, right? So if I have to turn this into percentage, how much it would be this? I'll just keep 2 decimal. Okay. Yeah. So now I know the weight. What is the next thing that we have to know? We have to know what is my cost of each capital. Cost of each capital would be, it would be considered, they said consider calculation purpose. Then here we already know it is of how much? 5.17 percentage. Now what is the weighted average cost of capital? WACC would be, all you have to do is multiply this. My 91.72 percentage of my capital has a cost of capital of 12 percentage, and my 8.2 percentage of my capital, my finance or my way mode of finance, has 5.17 percentage. If I have to consider the total weighted average cost of capital, it will be of how much? So I am just gonna consider directly. It is not required that you have to round off each and everything. Final answer can be rounded off. It is how much? Okay. Now look at the next requirement, that is requirement number D. They're asking you to calculate a project specific cost of capital equity for card company for the planned joint venture. They're planning a joint venture. See, for that, let's understand what is this joint venture all about. Let's read that first. You see, uh, so card company is planning to invest a significant amount of money into a joint venture in a new business area. It has identified a proxy company with a similar business risk to joint venture. Very nice. What is proxy company? Oh, it's okay if you don't know. Okay. Yeah. See, proxy company is just like, a company who can work on behalf of you. The proxy company has an equity, like, which is very similar to your business model. They have an equity beta of 1.038 and they are financed 75% of equity and 25% of debt on a market value basis. And right now we have risk-free return rate is 4%. The average equity risk premium is 5%, right? So, and they have given what? They have given they have given the company price profit tax of how much? 30%. They have given, I'm sorry, I thought they have not given. 1.6 is their beta. See, understand, guys, if you know what is the formula for asset beta, first we have to find out asset beta and this capital. So, let me go for it. Let's go to the requirement number ready. Cost of capital using capital asset pricing model. Do not write CAPM. Okay, I'll change it. You guys don't write CAPM, please. Capital asset pricing model. Okay, so what we have to do first, the proxy company's beta has to be ungeared. Yeah, find out proxy companies equity beta has to be ungeared, right? So you have to find out the asset beta first. So what is the formula for asset beta if you guys know? So I'll have to take the equity beta. Yeah, I'll have to take the equity beta. I'll write BE. Yeah, that is equity beta. Multiplied with what? Multiplied with, oh, wait a second. Weight of equity asset beta is equals to, take the bigger bracket. I'll take P of weight of equity divided by equity plus weight of debt multiplied with 1 minus tax rate. This multiplied with, this is the formula that we have to go ahead and apply. Correct, everyone? Yeah. So now understand, tell me, what would be considered as your asset beta? So first start with what is weight of equity? Weight of equity 75%. Correct? Yeah. So weight of equity would be 75% divided by weight of equity, that is 75% plus, open the bracket, 25% multiplied with 1 minus tax rate. How much is tax rate? 30%. Close this overall. Yeah. This overall oh my god, that's my number lock, so don't worry guys. This multiplied with, I'll just put bracket, or this bracket multiplied with the equity beta. How much is the equity beta, people? 1.038 if I'm not wrong. So I have to go ahead and calculate. So now understand, I'm not going to put everything same here. We know a lot of calculations. Start with 0.75. Why 0.75? I know the calculation already. 75% can be written as 0.75 divided by, open the bracket, 0.75 plus again open the bracket 0.25 multiplied with 0.7 because 1 minus tax rate is just 0.7. So close these two bracket. Whatever you get, this value, just put another bracket. This value multiplied with your equity beta. How much is your equity beta? This into 1.038. Will be of how much? It will be of somewhere around, am I getting 80.842? Point, it should be, what is my equity beta? My equity beta would be 0.842. Sorry, my asset beta is how much? My asset beta would be 0.842 people. Okay. Okay. Now understand, we have to go ahead and calculate the project specific cost of equity. So first identify, I have to find out the equity beta now. I know asset beta, but I should find out what? I should find out the equity beta. How do I find out the equity beta based on the company here? So for that, I will take the company specific. What is company specific, people? The company specific, I know the asset beta is how much? Asset beta is 0.842 or the equity beta would be. Now I have to, the asset beta must be re-geared to reflect the financial risk of card company. Correct? Yeah. So let me put that here. This is important. So how do we do this? So we have to find out the same formula you put out here. I already have calculated, isn't it, people? Yeah. So take this value. I know equity beta would have to be re-geared. So take this upon. First, I will go ahead and find out what? I will go ahead and find out the, open the bracket. What is the value here? The value is 57,280. Yeah. What is the value here? Value is 57,280. Let me write that. Open the bracket, 57 to 80 divided by, again open a small bracket, 57 to 80 plus, what is the debt there? The debt was 5171, but again 5171 multiplied with what? Multiplied with 1 minus tax rate. 1 minus tax rate is 30 percentage. Close the bracket, close two brackets, this, and close a bigger bracket, multiplied with what? Multiplied with the equity beta, asset beta that I've calculated, 0.842. So when I do this, how much we have to re-gear and how much it would be coming up. So I will take 57 to 80 divided by, open a bracket, 57 to 80. Oh my God. Okay. 57 to 80 divided by, again an open plus, open a bracket, 5171 multiplied with 0.7, close the bracket, close two brackets. Then I need to take the whole multiplied with 0.842. Correct? I'll put one more bracket here. Now you see, are we right? Oh, I should have found it. I'm sorry, it's my mistake. So I have to take this, okay, formula, and okay. I know the asset beta now. I have to find out this. So what is my asset beta? My asset beta would be my asset beta would be how much? My asset beta would be 0.842. Right? This is equals to, open the bracket, weight of equity would be how much? Weight of equity would be 57 to 80. Yeah. So that divided by, open the bracket, 57 to 80 plus, open the bracket, 5171 multiplied with, open the bracket, 1 minus tax rate is 30 percentage, close the bracket, another bracket, in the bigger bracket, multiplied with the x value, that is equity beta. I should find out equity beta. So if I have to find out equity beta, I'll put this words that side. Yeah. So if I have to put that thing as this side, what I have to do, I can multiply with 8.42. I'll multiply whatever is there in the denominator and divide by whatever there is in the numerator. Correct? So my equity beta would be is equals to what? this would be is equals to, I will take 0 point, yeah, I would take or else or whatever the numerator first. The numerator would be 57, sorry, the denominator would be 57 to 80 on this side. So on the left hand side it becomes numerator plus 5171 multiplied with 1 minus tax rate, that is 30 percentage. Close this, right? I'll also close this. I'm sorry about it. Yeah, close two brackets, and then this whole divided by 57 to 80, and this whole divided by 0.842. This is what we would be doing. So when we do this, how much are we going to get? Let's do that in the Excel, people. So take the bracket 57 to 80 plus open the bracket 5171 multiplied with 0.7, close, close the bracket, and then I divided by 57 to 80 again. Yeah, now again I'll close the bracket. Okay, am I doing this? No, this multiplied with 0.842. Oh, okay. Oh my god, no. What is the mistake that I made? Divided by, oh, I might have made a mistake here, guys. Yeah, now you see there might be, yes. So what is my equity beta? My equity beta would be 0.895. Now with this equity beta, let's go ahead and find out the project specific cost of capital. So what is project specific cost of capital, people? What is the formula for project specific cost of equity by any chance, if you guys know? Yeah, what is project specific cost of capital that we take, people? The cost of equity would be risk-free return plus, let me take that. So what would be project specific cost of equity? To be risk-free rate, we already know what is risk-free rate. Yeah, but what is risk-free rate, people? 4 percentage plus, open the bracket, what is project beta, which we have already calculated, would be of project beta is 0.895, then multiplied with what is the market return that we can expect to have. What is the market return that we can expect to have as people? The market return that we are expecting to have, are they, did they directly given you what is equity risk premium? I think market return minus risk free rate return, they have directly given equity risk premium, equity ERM they have given is 5 percentage. If I have to calculate what is my project specific, it will be 4 percentage plus 0.895 multiplied with 5 percentage. How much it will be? It will be 8.5 percentage. This is my project specific cost of capital. So you do this, how many marks you can expect to have? You can expect to have itna ke liye hardly like 4 marks. Okay. Now we'll move to the last requirement, people. The fifth requirement that we have is discuss the factors to be considered in choosing between trade loan notes, new equity issued via a placing, and venture capitals as sources of finance. What are they trying to say? You have to talk about trade loan notes or new equity that you can issue via placing, or if not venture capital as a source of finance. Okay, so this is the requirement number E that they are asking you to talk about. See, let's have a discussion first and then I would give you the ideal answer. Understand, rated loan notes are debt securities. Okay, this is issued into the capital market in exchange for the cash to be received. And you issue either loan notes, debentures, bonds, whatever it is. The cash will be raised, has to be repaid back on a particular redemption rate. What is this redemption date would be? You can expect to have yeah, so you can expect to have a day where you have to go ahead and consider. Okay, so at this point of time, what you have to do, you have to pay back to the people who have given the cash to you. All right. So now, loan notes are usually secured or non-current asset of the issuing company. So that's, what do you mean by that? If I don't get paid, like there's a chance where you would be paying it. That's how it works. You would be matlab, like not you. The company has something called assets, right? Non-current assets, those things would get paid off for you, so which makes your life little easy. Okay. Okay. Now, see, in the event of default on any interest payments by the borrower, that is the company, so the loan notes holders can appoint a receiver to sell the assets and recover their investments. Like a whole, everybody comes up and says that we want to sell all those loan notes, and then we want to, we want all the assets to be sold, and they have to be repaid back. They can go ahead and repay. Okay. So interest paid on the loan notes is generally tax deductible for the company. So that means, like, if company is paying an interest, we can expect to have tax to be deducted on that. First thing, which reduces the cost of debt to the issuing company. That's the reason one of the cheapest source of loan would be cost of, like, that would be debt. Okay, provided the borrower continues to pay interest. However, loan note finance is a low risk financing choice by the issuer. That's what I've told you already. Like, one of the cheapest source of finance would be considered as what? Debt. A placing involves raising finance through the sale of shares of selected industrial investors. So you need to understand there's always a difference between loan note and the equity. Yeah. So the loan note can be redeemed back. That means you would be paid back, right? But the finance, the equity finance cannot be repaid. So what do you mean by equity finance cannot be repaid? For example, I go and invest in a company as equity. Do you think I have an option to go ahead and consider the amount to be paid until unless the company is getting liquidated? They will not pay back anything. So since ordinary shares are truly permanent finance, like it once you have paid to them, that will not be coming back. Okay. So while the loan note interest is usually fixed, the return to the shareholders in the form of dividend depends on the dividend decisions made by the directors of a company. So sometimes what you can expect to have, the more return comes, more dividend comes, less return comes, less return dividend comes. But if you are into the concept of what, if you are into the concept of loan note, you can expect to have what, you can expect to have a fixed amount. Like, it doesn't matter whether the company is earning more or not, you can go ahead and consider the same thing. Okay. So now, apart from this, see, again, since it is decided by the directors, it depends on how many, what is the shareholding of the directors as well. So furthermore, since dividend is or the distribution after tax profit, they are not deductible like interest payments. So for company, equity would be the equity is going to be costlier than the debt. Okay, so these are the two differences between loan notes and the equity. And they have also spoken about venture capital. Let's understand venture capital. The venture capital is found in specific financing situations. It doesn't happen most of the times, people. So why it happens on a specific finance situations, considering, one second. Yeah. So considering, one of the pointers, like, it is not suitable for all companies or all of the companies. It depends on the people to people. Okay. So understanding, venture capital is found in very specific financing situations, people, where the risk finance is needed. For example, in a management buyout. What is management buyout? Like, the company, the directors would like to go buy the all the shares at that point of time, you can expect to have. Both equity and debt finance can be a part of venture capital financing package, but the return expected on venture capital is high because the level of risk faced by the investors would be high. Ma'am, what do you mean by this? That means somebody who invests on my company, if they're a venture capitalist, see, you are no one to them. Why do you think they will come and invest in you? Because the one thing that comes up to them is like you might be really good at in your business. That's the only thing, that they might come up and invest in you. Now the point is, if they have to come up and invest in you, and there should be an investment option, like they have to go ahead and identify everything. At that point of time, you can expect to have very less number of returns that you can be given to them. Correct, people? Yeah. So they don't really want to identify all of that. You can expect to have very less return percentage given to them, by the way. All right, that could be one of the reasons where venture capital is very rare in nature. So that's about the requirement number E. I would give an ideal answer that you can go ahead and write. You can make around 5 to 6 points on that. Like each source of capital, you can write two points. I will just shorten this and write the heading for this. Okay. Okay, I believe now you can see the answer, and this would be an ideal answer that you can write for this whole question. So, ma'am, each capital में you can write two points, that should be fine, or write three points each. And venture capitalist में, since it is not something that you know more, you can go ahead and write just a point, which is still considered. Okay, as long as you are writing down the points, it should be fine. All right, people. So now this is about the whole weighted average cost of capital. I'll see if I can schedule one more class for you guys. It depends on the availability, but however, you should know that we have whatever we have gone through till now, right? So this should help you in your examination, like maybe a last minute quick revision of your entire. I think we have done investment appraisal, we have done cost of capital, I think we have also gotten some of business risk evaluation, right? All of this should help you in terms of long run, I believe, for your examinations. So I believe you guys would have, if you're watching this, I'm sure you would have already booked your sessions and you're waiting to write your examination very soon. So my heartily congratulations to all of you guys, and very all the best for what you're gonna do in upcoming session, that is your examination. And professional paper to complete. So if you guys need any guidance, all you can do is under this video you can see there might be lot of links which would be given on that. So be it you joining the Plutus education, or you can get assistance form, or you can join to Telegram channel for us. So you can go ahead and contact us, and support email ID is also given. If you need to talk to me, you can of course get through to plutuseducation.com. Okay, so thank you so much for being a wonderful audience for today. So I would get in touch with you guys for the upcoming sessions. Thank you so much, guys. Thank you so much.